Inheritance tax in Ireland is not a new thing. Today, if you're lucky enough to either be in line for a substantial inheritance from mum and dad, or you are mum and dad and you're leaving substantial assets behind you, your children can inherit €335,000 without tax, and they pay 33% tax over and above that amount. So to make the maths nice and easy, if a child is inheriting €1.335 million, they get the 335,000 tax-free, and they pay €333,000 in tax on the balance. If I had been recording this podcast a decade ago, the tax-free thresholds were far higher and the tax rate was far lower. So inheritance tax has been growing exponentially in Ireland over the last decade or so. Go back to that example of 1.335 million. The inheritance tax 20 years ago would have been in the region of about €100,000 as opposed to €333,000. Now, some people think this tax is fair. They say it makes sure that the wealthy don't hoard assets and they get spread around. I'm not one of those people. I think this is a particularly unfair tax. Because if you think about it, if you're the donor or the recipient, but the donors have paid a huge amount of income tax, capital gains tax, local property tax, VAT, etc., all of these taxes have been paid as the assets were accumulated. And yet, as those same assets are passed to the next generation, a further big whack of tax is payable. Is it possible to reduce those tax liabilities? I'm glad to say it is possible. And there are multiple ways of doing this perfectly legitimately. But as you've heard me say before, the only people who can exercise their right to reduce these taxes are you. You're the people, either the donors or the beneficiaries or both. Both have substantial actions they can take that will reduce the liabilities. So how does that work? What can be done? Well, many things can be done, and I'm not going to go into great detail here on each of them, but let me give you a few examples. I was talking to a person on a consult recently, and part of his assets, which were substantial, in excess of 10 million, was a farm worth 2 million. His will said, I leave everything equally to my children. But what he wasn't told as he made this will was that meant that none of his children would be able to qualify for what is called agricultural relief. Agricultural relief effectively reduces the taxable value of an asset to 10% of its real value. So a 2 million farm with agricultural relief drops in value for inheritance tax calculation purposes to €200,000. And that's below the tax-free threshold. But the reason you can't leave that farm, or my customer I was talking to shouldn't leave that farm to 4 of them, and all the other assets to 4 of them, was that none of them would qualify for agricultural relief, because the beneficiary has to be a farmer to gain that tax credit. Now, to you and me, a farmer is somebody perhaps who puts on Wellington boots at 3 o'clock in the morning and goes milks the cows. That sounds like a farmer to me, but that's not how the revenue define a farmer. A farmer, according to the revenue, for the purposes of qualifying for the relief I've spoken about, is somebody who, after receiving the inheritance, 50% or more of their assets are agricultural. So you can see where my customer was concerned. Dividing the farm in 4 and all the other assets in 4 meant that none of his children would be able to qualify. So there are other exemptions, business assets relief, exempt assets, and so on and so forth. So my point to you is that you need to understand what the exemptions are that apply to your estate, be you the donor or the beneficiary, and you need to manipulate your bequests so that as many of those legitimate tax concessions can be claimed as possible. Inheritance tax is here to stay. Inheritance tax is part of the tax system. Rates will change, no doubt. You've heard me say it before. I'm not clairvoyant, but I do confidently predict that tomorrow will be different than today. And that is true in inheritance tax as well as anything else. What else should be done? Again, taking from a consult with a customer from a recent meeting I had. This customer had 6 grandchildren. And what I explained to them is that the grandchildren each have a tax-free threshold of their own, which today is about €32,500. So if they left that €32,500 to the grandchildren's parents, they would pay 33% tax on it because they were over the threshold. Whereas if they left that $32,500 to the grandchild would pay zero tax on it. So by using the tax-free thresholds for their grandchildren, in that example, 6 times €12,000 thereabouts was saved. That is €72,000 reduction in inheritance tax, in this case by changing who is receiving the asset. Now, one of the reasons parents and grandparents perhaps don't like to leave large amounts of money to children is that the children are very young and they don't trust that the children would be able to look after the money. And this is where perhaps a trust fund can come to bear. A trust fund, there are many different types of trust, but one of the types of trusts that exist allows you to divorce ownership from control. Think of it this way. The board of AIB makes AIB decisions, but they don't own AIB. The shareholders own AIB. So there is a divorce there of ownership, the shareholders, versus control, the board of management. This is possible to achieve through a trust fund, where the beneficial owners, in this case, example I'm using, the beneficial owners being the grandchildren, but the trustees are the parents of those children. So the asset belongs to the grandchild and the 32,500 tax-free threshold can be used, but the decisions around those assets are made by that child's parents, the trustees. So in this way, you can use all available tax-free thresholds. And in the event that one of the beneficiaries, as you use them, is too young or too inexperienced to look after that asset, you can divorce ownership from control by using a trust fund. What else can be done? There is an exemption in Ireland to various assets from time to time are exempt from inheritance tax. I was in a law office in Dublin recently, just off Earlsworth Terrace there. And as I walked into this very substantial company or law company, the reception is filled with Graham Nuttall art. And I was with a client and I said to them, there's a succession plan of the partners. And he said, what do you mean? I said, well, art on public display, once it's properly registered with revenue, is free from inheritance tax. So you give €1 million to a beneficiary over and above their threshold. They pay €333,000 in tax on that. You give them €1 million worth of a Nuttall that is on public display and they pay zero tax on that. So if you're looking for ways, you've heard me say it before, legitimate tax concessions are enjoyed by looking into the future, asking what's likely to happen, and then changing today to de-tax those events in the future. So if you have substantial assets to leave behind you, you will be able to calculate how much of those assets are guaranteed to be left behind. So calculate how much of the assets you're going to use yourself between now and the time you shuffle off this mortal coil. And once you have that calculation done, compare that to your whole estate value. And let's say that means there's a couple of €1 million that you know is definitely going to be inherited. Maybe the best investment option for that couple of €1 million is a tax-exempt asset. Even if that tax-exempt asset will not deliver the same growth rate as the other assets you're using right now, the very fact that your children won't pay inheritance tax on it when they inherit it means that it can underperform from an investment point of view and still deliver greater assets to your children when that time eventually comes. I had a client, a friend of mine years ago, and he'd lost his wife, unfortunately. She died of cancer. He had 3 teenage daughters. And about 10 years after losing his wife, he met another lady and they eventually got married. And we played tennis together. We were in the Riverview Tennis Club there in Clonskee. And we were having lunch after our game and he was telling me about going to his solicitor and writing a new will. And basically he told me I've left everything to my wife and with instructions that she leaves them to my children. And I threw my eyes up to heaven and he said, what's wrong with that? I said, the issue here is that your children are not your new wife's children. At the time, the tax-free threshold was about €500,000 per child. I told him, you've just put €1.5 million of your assets in the tax net that don't need to be there. And he said, well, why didn't my solicitor tell me? Not his job, not her job. Your solicitor's job is to do what you tell them. They write it down. You told them you wanted to leave everything to your wife and then instruct her to leave them to your children. That would mean that eventually your children were inheriting from a stranger in legal terms, in tax law terms. He said, what's the solution? The solution is easy, and it was easy. 2 solutions to that problem. Either the new lady adopts the children and becomes their mother, and therefore the tax-free thresholds parent to child apply, or you leave the assets to your wife as a lifetime interest and onwards to your children, so that when your children eventually get the asset, they're inheriting from dad, not from new wife. That broadly, because at the time I said the tax-free threshold was 500 grand, the tax liability at that time was 20%. 20% of 1.5 million is €300,000. That conversation in the Riverview Tennis Club saved my friend's children €300,000. He bought lunch. The message here is that it is perfectly reasonable and perfectly possible to plan succession. Another message I want to let you know is that your succession is not without legislative interference. There's a law in this country called the Succession Act of 1965, and it dictates what is allowable and what is not allowable. And I'm not going to go into that detail on that here. But know that making your will is not without legislative interference, and that what you need, not only a lawyer who will do what you tell them to do, but a good top-class financial planner who will introduce you to these legitimate tax breaks and help you plan your succession so that your children pay as little tax as legitimately possible.